Hey traders, this is Blake Morrow with Trader Summit, and I have with me today, I have Mr. Adem Tumerkan from Speculators Anonymous. Good to see you, Adam. How are you?
Hey everyone, how's it going?
Adam, we were going to have a chat about China because China's in the news this week. They have a big meeting, the Politburo meeting that's happening this week. A lot of stimulus talks, and they've been up to this point. They've been fairly unsuccessful getting their economy off the ground. Why is that, and what can China do to really stimulate their economy?
Yeah, so China, it kind of goes back a little bit, but just to give you some context, in the early 2000s, China was grossly underinvested. So you had an enormous amount of capital going to infrastructure. And remember, GDP is calculated out of 100, right? You got consumption, government, exports, investment. So for one to rise, somewhere else has to decline. China went all in on investment, which most developing countries do. The problem is they're now the second largest economy in the world. I wouldn't call them developing at this point. I know according to IMF standards, it's with a real GDP per capita of like 13,000 is the break off. They're at like 12,500. So they're pretty much developed at this point. And historically, like the US, when Britain was the reserve currency, Britain was a major exporter of goods and exporter pre-World War I. Then the US became a very big investment-driven economy. And then after World War II, America shifted to consumption, and that required deficits, more consumer purchasing power, more imports. China, they're not even in the top. If you actually look at the country's consumption shares of GDP, China's not even in the top 20, and they're the second largest economy in the world. So their consumption share is very low relative to other advanced worlds. And you see the same problem. If you look at the top countries in consumption, it's like America, the UK, the Philippines, Poland, etc. They all run deficits, essentially. Look at the bottom bracket with weak household consumption. It's like China, Germany, South Korea, Japan, Saudi Arabia, right? And they all run surpluses. China, being so investment-led, the problem is you hit the law of diminishing returns. It's inescapable. Every new investment dollar they're putting in is essentially losing money at this point. They're not making any returns. So they should be rebalancing. But Japan ran into this problem after they were a massive export economy in the 1980s. Japan tried rebalancing. They found it extremely politically unpalatable, and it just lingered for the next 30 years. So China today is essentially stuck in that situation where they would have to reduce their investment share of GDP and raise household share. But to do that, you would have to deal with low growth, high unemployment to rebalance your economy.
So that makes sense to me. But China's been desperately over the last 20 years trying to change their economy to more of a consumption economy. And what you're telling me at this point in time, they've been fairly unsuccessful. But
yeah, they've talked about it, but that's been the whole thing for 20 years, right? China, 1 billion people are going to be a big consumer, overtake the world. And 20 years later, it's worse now.
You say it's worse now, but you take a lot of the companies like I just because it's in recent memory, the Richemont Group from last week, their earnings came in horribly, and the stock was down 10% after earnings, and they cited really poor China consumption from the high end, but a lot of these groups have really cited China consumption to spur on their earnings over the last couple of years. So why the dramatic shift there?
So China, there's a good theory by Richard Koo, who was the head macro analyst at Nomura. I think he's still the chief macro guy there, but he basically wrote this about Japan, and he called it a balance sheet recession. And the idea is when the consumer is so leveraged, or a lot of their household wealth is in an asset, usually real estate, and you have a lot of debt driving it, when the asset price falls, it wrecks the balance sheets. Borrowers can't borrow. They're scared to borrow. Why would you catch a falling knife, right? You're not going to invest in more property. The whole idea is you buy the property, it rises in capital appreciation. China's entire house, they have a lot of household debt too. A lot of people don't realize for how relatively anemic their consumer is, their household debt to GDP is already above 60%. The US is like 73. So, I mean, they're pretty leveraged. It's risen almost 300% since 2010. So a lot of it, 70+% of household wealth for the Chinese are in real estate. And as real estate prices have started slumping the last couple of years, you could see how it's taken, it's had its impact on the debtors. Loan creation, household debt to GDP in China has been flat for 4 years. They're actually repaying their mortgages faster. And the thing is, when you are paying down debt faster and no new loan creations, like Chinese mortgage applications have collapsed because you're extinguishing money and it's very deflationary, right? Because you're repaying your loan faster. Instead, you can only do two things with the same dollar. You either consume, pay down debt, or save. The Chinese are huge savers, and they're also now repaying debt faster. So it doesn't matter if they cut interest rates, and that's what Japan ran into, because if there's no loan demand, interest rates will just keep falling, so will deflation, and so will growth, because the credit, taking out a loan, you're using it to buy something, right? It's going into the system somehow. But when you're repaying the debt, you're extinguishing the loan. So China's essentially pushing on string, and we saw them cut interest rates. It hasn't done anything. They're probably going to push it lower. They're already in both producer deflation, the worst they've been in almost a decade, and actually the last time it was this bad, I think it was 2015 when they did their shock devaluation, and their CPI is in deflation right now. So it's kind of telling that. And if you have deflation and you have a leveraged economy like China, that's a, you know, the central banks look at deflation like that, especially asset deflation, as the plague.
Right. Okay. Well, let me ask you this then. You know, is there anything that China can do at this point to turn their economy around, in your view?
I think they would have to restructure a lot of the local government debts who are in charge of a lot of these. You know, Beijing influences everything, but, you know, it's the local governments that have their own, you know, agendas and how they raise capital. I think they would have to implement more social safety nets so people will stop saving, like give them some kind of social security, you know, Medicare, more improved system so they can spend now knowing that they're going to get that money later for whatever retirement. They have this thing called the Hoku system, which is essentially whatever province you're born in, you're tied to that policy of healthcare and et cetera. And it's almost impossible and extremely costly to change your Hoku system. And they essentially did it to keep out the rural population from coming into the cities. They need to change that. And they have a bad wealth inequality problem. And they'd have to stop just focusing on, they'd have to be willing to give up their surpluses. They'd have to be willing to say, all right, we need to let the yuan rise. We need to, like, dramatically allow imports more into our country, let our FX flows flow out. The problem is, if they let their currency rise that much, it's deflationary in their economy, and it could pop their asset book. And that's what happened with Japan when they let their currency appreciate. And after 1986 with America, what did the BOJ do to offset that deflationary effect from the rapidly increasing yen? They stepped on the gas on monetary policy, and it fueled a huge bubble. So they would have to be willing to go through some pain to rebalance their economy. Otherwise, I don't really see how they'll get out of it unless the consumer suddenly gets way more thrifty.
All right. Well, let me ask you one last question then. Where, if you're not gonna be in China, what's the best place? Where's the best place you should be trading, or how would you take advantage of this in it from a trading point of view?
Yeah, it's hard to say, because if China goes down, you know, I mean, you're looking at Australia, a lot of commodity export, you know, the ones that boomed post 2008 because of China rising, I'm sure they're going to feel it. But I think on a manufacturing capacity or growth perspective, I do think that India, even though India is like the golden goose that's never laid an egg, they are grossly underinvested. I think they could capitalize on this. And I think that's why we're seeing India not want to be part of like the BRICS currency. They're like, why would we peg ourselves to a global fading engine in China and 3 stagnant export economies in Russia, South Africa, Brazil? So I think India could be attractive, but it's hard to see. I think commodities might be hit, maybe Southeast Asia.
Okay. Well, Adam, I want to say I love your analysis, your insights. What's the best way for us as traders to follow your work?
Yeah, you guys could just follow me on Twitter at Radical Adam, Adam with an E, ADEM, and then speculatorsAnonymous.com.
Well, Adam, I always enjoy having our conversations here on the Trader Summit. If you guys and gals like what you hear here, make sure you give him a big thumbs up. Subscribe to the channel down below so you don't miss any of this exclusive content. Adam, until our next conversation, have a great day and stay cool where you're at.
You too, Blake. Take it easy.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.